Second quarter earnings season kicks off this week. We've got the big banks on tap tomorrow and Friday, and big tech not far behind. Markets looking to make the most of the second half of the year following a volatile first half and a contraction in the first quarter. Joining me right now is Bank of America's Vice Chairman and Chief Investment Officer of the Pension and Benefits Plan, Keith Banks. Keith, great to see you.
Great to be here, Maria.
Thanks so much for being here. I want to ask you specifically about pensions and savings because I know you have new data on the consumer. We'll get to that in a second. But first, assess where we are in terms of the earnings period, in terms of all of the data coming out. How would you characterize the macro story, and what are you expecting out of the second half of the year?
Well, we're at a very interesting point. One of the things that we're concerned about right now is we believe that the consensus earnings estimates are still too high. And look, there's always a lag. We get that. But right now they're saying, the consensus is saying 2023 will be up between 8 and 10%. But if you look at the deceleration in the economy that we're expecting, and Bank of America Global Research just took down their forecast for the rest of this year and next year, and you look at all the headwinds coming between the slowdown in money supply, the quantitative tightening, and the fact that we believe over the next 4 meetings, you are in fact going to see 175 basis points of rate increases. We just don't see how the consensus numbers are close to being right. The risk in our mind is year-over-year numbers are flat or down. And if that's the case, you're going to be hard-pressed to see a sustained move up in the markets.
So just to be clear, if your team is looking for negative, then they think we're in a recession right now.
Yeah, the forecast they recently reflected as of literally this week is they're now looking for negative. B of A Global Research is now looking for negative growth each quarter for the rest of this year, as well as the first quarter of next year. And the real driver of that in their minds is the fact that this inflation tax is real and starting to bite. So one of the things that we're seeing, Maria, and you know, we look at the aggregate credit and debit card data at Bank of America, which is tens of millions of customers.
Such good info.
Yeah, and so what we're seeing now is even though in June, aggregate spending was up 11%, which on the surface you say that's a strong number. But when you look at it on a per household basis, which probably is more reflective of true consumer activity, it's only up 3.3%. That actually will be below the inflation numbers in June, which means real spending is negative. And even more interesting is if you strip out spending on gasoline and food, spending is actually down 1% for the lower income cohort. And even for the higher income cohort, spending is clearly in a downtrend.
Okay. So then they are changing behavior as a result of the inflation eating away at their wages. Americans are.
Yeah. So the inflation tax is real, and it's starting to bite, and we're starting to see that now in the consumer spending data.
How much of a concern is it for you that they're going into pensions, going into savings accounts to actually pay for the essentials?
You know, it's interesting. So one of the things we've talked about before with you is the fact that, you know, because of all the stimulus, the consumer actually was flush with cash. Now, their savings in both checking and savings accounts are still above 2019 levels. They have been drawing it down. We expect that will probably continue, unless they decide that they're going to just pull back and leave that money sitting there. And that's going to be one of the big decisions that need to be made and will impact overall growth.
What do you think it's going to take to get us out of this? I mean, the Federal Reserve is obviously slamming on the brakes, you know, 75 basis points last time, 75 basis points in the next 2 weeks. But the administration and the Securities and Exchange Commission is proposing new climate rules, and that's going to have an impact on business. It's raising costs for business. So is there any end in sight that you can see?
We think it's going to take probably until the middle of next year at the earliest, because the bottom line is this. The Fed has got to create demand destruction. As a result of all the stimulus that we saw, and appropriately so because of the pandemic, demand grew at 10%. Over the prior decade, the average demand growth was 4%. So you got to break the back of demand because supply is not going to come back fast enough to really solve the problem. So inflation will continue to be out there and be an issue until demand destruction occurs to a sufficient degree. And we think that probably happens by the middle of next year at the earliest.
If you were long this market at the start of the year, you are down almost 30% in tech. You're down in the double digits on the Dow, the S&P 500. you've got to put money to work regardless of the macro story. How are you dealing with this as an investor?
So right now we think there's a couple of keys. Number one, you have to be very diversified. We actually just lowered our weighting in equities to neutral. We had been slightly overweight. We did that by reducing our exposure to small cap. We increased our fixed income weighting somewhat, and we also got more defensive within sectors. So we increased our weightings of utilities, of consumer staples. We reduced our weightings of consumer discretionary and materials. So we think you need to be diversified, need to be defensive, and also increasingly we want to embed things like real assets, because that's the true hedge against inflation. What we found out, and was true in the 70s, in periods of high inflation, bonds and stocks become very correlated, meaning one doesn't offset the other. So you had both coming down. To your point, even long bonds in the first half were down 20%. Government investment grade was down 14%. So there was nowhere to hide, and that was part of what exacerbated the returns for investors.
When you say have some real assets as part of your portfolio, you're telling me to buy gold, buy commodities. What do you mean, tangible assets? Real estate?
Real estate, commodities. We prefer doing it through real estate. Some of the, if your risk tolerance allows it, some of the alternative investment opportunities out there can help you, because you have to go beyond just the traditional 60-40, because that did not help you in the first half and probably will not continue to help you if inflation stays high, which we think it will for a period of time.
You're talking about 60% stocks, 40% bonds.
Correct.
At that point.
Yep.
It's great to get your insights.
Always great to be here.
Thank you so much.
Thank you,
Keith
Maria.
Banks joining us this morning, Bank of America.